So you want to become a full-time trader, but you don't even know where to start. Now, this video is going to be the ultimate guide from start to finish. Everything I have known for the past few years, I'm putting everything in this video. And this video is honestly just going to be value. I'm not here to sell you anything. It's going to be everything I have known. And if somebody asked me in the beginning, how do I get started? Or even an advanced trader, how can I get better? We're going to cover everything. Now remember guys, this is going to be quite a long video, between 1 to 2 hours long. So if you are not free for the entire video, come back another time. Honestly, because we're going to be taking so many notes, I expect every single one of you to be paying attention. So guys, let's get straight into it. Alright, so we're finally getting started. The complete trading course from start to finish. Now, you might be wondering, how am I going to split this up? It's going to be very, very simple. From start to finish, going to be split up in 7 modules. Starting off from beginning, we've got the introduction and the psychology, moving into some of the more basics of trading, some technical information. Then towards the end is really when we get into some of the more advanced topics, especially when it comes to liquidity and the whole idea of how I base my elite strategy nowadays. Now, as I've said and as I've promised, throughout this year, I'm going to be providing as much free value as possible. Now, I've started up a completely free Discord server. This is going to be open to the public completely. Now, if you do want to enter, obviously the link is down below. Obviously over there, I'll be sending free PDF guides. People can literally learn off each other, a whole trading community for completely free, no penny to be paid. So as we get into this, we're going to be starting off with chapter 1, the complete introduction. Now, the one thing that beginners ask me in the beginning is, how do I even get started? So the one thing I want to make clear is your roadmap. Before you get into any business venture at all, what do? You always plan ahead. You always plan your first few steps, and then obviously, where do you see yourself in 6 to 12 months, 6 to 18 months, anything like that? You have to understand what your roadmap is. Now, in terms of a usual roadmap, this is how it goes. You start off with the education, such as this course, and then obviously you're applying the knowledge, right? You're learning it. Now, the one thing that a lot of people do is they learn this knowledge, they see this entire video, they take notes, and then they get straight into the live markets. That is where people mess up. Now, the one thing that I can't do as a mentor, anything like that, at this moment in time, you're literally just coming across me on a YouTube video. I can't come into your life and obviously help you with the next few steps. It really is going to be up to you. And this is where I say psychology plays a massive part, because so many people, they understand the knowledge. They've taken so many notes. I know traders that have been in this industry for 3 years plus, and they're still at the same level. They're still trying to pass funded accounts. They're still trying to get a grip on the markets. This is the one thing you need to understand. Set a roadmap. Now, the way I would usually define it is this. You start off with your education. You learn the knowledge, exactly what we're doing in this entire webinar series. Then we start to develop an actual profitable strategy. Now, of course, with everything that I provide to you, are you going to be instantly profitable? No. There is no, honestly, if you ask me, I'm not going to try and sell you anything. If anything, everything here is for free. Developing a profitable strategy takes time. It takes knowledge even. You have the knowledge, but it's all about putting it together. Now, this is the most important bit in my opinion, the testing stage. Now, if you were to ask me, how did I even test my strategies and everything like that? It's not something that came instantly. It's something that took a while. The testing stage for me personally, or the back testing, went something like this. For every single pair that I want to test and actually try out, for example, let's take a look at Euro USD. When me and my mentors were coming up with my strategy and everything, we started off with Euro USD, and we only started off with 2 years of data. From that point onwards, what we did on the 5-minute chart, we pretty much backtested every single candle that came up for the past 2 years. Then we went on the previous year, and then the previous year before that. So 4 years of data. Then moving on to another pair, GBP USD, Euro GBP. This is the type of thing you have to do. Honestly, if somebody comes to me and says, look, Driller, trading is not working out for me, and it just, I don't know what it is. I understand the knowledge, it's simply just not working. I know instantly if that trader has not backtested for at least 1 year of data on one pair, you're not even trying. Seriously, you are not even trying. If there's one thing I want you to learn is this. Throughout this video, you're going to be understanding the knowledge, but until you go out and test it, you're going to be going nowhere. So that's one thing I want to put into your head. Now, the next part, what is it all going to be about? It's applying it via demo/low funds. For me personally, I think demo is a great place, obviously, as you're starting out, to be honest. But where it really starts to hit you is when even you're working on low funds. Now, it just depends on the amount of investment that you have, the amount of capital that you have. If you are working on low funds, again, it's not going to hit your psychology as much if it's not all of your savings or anything like that. Again, one thing I do urge traders, especially getting into this at the start, is this. if you are getting into trading, thinking you're going to be making tens of thousands, especially in the beginning, trust me, you need a few things in line. First of all, you need your psychology, you need your roadmap. That needs to be set up. But also financially as well, you need to be thinking about it. How am I going to be able to support this journey? You know, people tell you, a lot of these gurus online, they tell you can start for completely free and you can become a profitable trader within 30 days. That's not the reality. Many people take years, months, if not years, to even become profitable. Now, with all of this, what I do recommend is this: have a second income or some kind of savings on the side. If you don't have that at all, get to working on that, because the psychological hit that you're going to be receiving on your head as you're trading and as you're working with either these low funds or even going for these challenges, it really is going to be taking a hit on you. So that's the one thing I will say. Have a bit of ease of mind as you are getting into all of this, and trust me, your roadmap will go a lot more smoother. Now, finally, it's all going to be about applying it to the live markets. Now, this can come in the form of prop trading, going for these challenges, going for, funding your own live accounts, especially in the beginning. You're going to be funding a smaller account and obviously growing that over time. But yeah, guys, this is pretty much going to be the roadmap. Very, very simple. Now, like I've said from the start, this course is only going to cover so much. And in fact, I'm only going to say it's probably going to cover only 2 parts of this. This is why I urge you, join the free Discord, because you're going to be seeing so many members that are like yourself. Whether you're starting out or whether you're an advanced trader, of course, there's going to be people of many, many different levels. And obviously, as you go through there, we're going to be understanding how many people there are in there. But yeah, guys, all I can help you out with it is the first 2 stages. I want you to understand, backtest the hell out of your strategy. Start your strategy, make it, test it on one chart, one trade, one currency, my bad. And obviously test it for quite some time. And then obviously that's when we can start getting into everything else. So have I made it clear? Very, very simple. Let's get into the rest of the video. Okay, so now moving on to chapter number 2. This is going to be the basics of trading. Now, I'll be honest, if you are more of an advanced trader, I would recommend you could skip this section. I am going to be clipping up every single part of this whole YouTube video, split up into different sections. So obviously you can just proceed to the next one. However, if you are a complete beginner, trust me, you do not want to miss this stage at all. Now, in terms of how we can actually make money from Forex, obviously you're here for one reason, right? You're not here just to listen to some random guy ramble on YouTube. You're here to actually make money. Now, how do we make money in the Forex markets? Now, the one thing you need to understand is this: your trading knowledge and your strategy plus funding. This is the most important thing. Plus that funding is going to make you that money, because you can have all the knowledge in the world. And this is the one thing I urge traders, especially in the beginning, forget about the funding part for now, because funding will come. There's so many funding opportunities within the Forex market, because you must understand this is one of the most liquid markets and one of the most biggest markets in the world. Something that, retail traders like ourselves can get into very, very simply. Before it was very much, you'd have to go through institutions, but in the past 20 years or so, it's become very much a retail space as well, and very easy for us to get into. So again, the one thing you must understand first is the trading knowledge and strategy must be built on first of all. Now, in terms of the steps taken to success, in my eyes, would be this: learning the knowledge, applying this knowledge via demo and backtesting, as we've talked about in this previous section. Once you see profitability, and only once you see profitability in the testing section, that's when we can get onto a live account. Now, there's a few ways that you can actually go about this in terms of making money. You can either build a track record, longer term for larger investors. Typically, this will happen anyways along your journey, whether you're going down the prop firm route, whether you're going down your own capital. Now, I must say this, in the past few years, the whole scope of retail trading has changed. Now there's so many simulated accounts with prop firms that you can actually get into. This is a really easy way to actually leverage your way to success, because, with a simple $500, for example, with a 100K account, even $1,000 for a 200K account, you could really leverage that to your advantage, especially long term. This is not something that we've typically seen before in the industry, especially back in the day. I would say when I started in my journey back in 2018, when I was really introduced to trading, in the beginning, I didn't really hear about this prop firm type of industry, but now it's really popped off, especially since, 2020, 2021. That's when prop firms have really started off. So one piece of advice as well, only stick to the big prop firms, because as we've seen time and time again with these prop firms, they are likely to, in a way, pay people out, especially from the people taking the challenges. So if you understand this business model, you understand that you need to put your investment into the challenge, pass the challenge, and get your money out as soon as possible. The whole long-term goal is to fund your own account, and then obviously go to build a track record for larger investors. Now, how can profits be actually guaranteed? Again, we must look at a few things. It's going to be starting off with your trading capital. This will represent 100% of your trading account. So let's say you started off with 100K. You are now going to be looking for a percentage gain of that every single month. So let's say, for example, you're looking for a 5% gain for the month and you're working on a 100K account. That obviously is going to be meaning that you're working to get that, that 5K payout. Now, in terms of a prop firm, obviously there are going to be percentage splits. You do have to calculate that and obviously look at that long term. Now, the 3 ways to actually make money, as I've said, your personal capital, it's all about compounding the account. Understand how important the compounding effect is. Again, even when it comes to investing in other things as well, compounding your money is very, very important. And this is the ways that millionaires get to, multi-millionaires even. Now we're looking at the second part, prop firm. So it's all about, as I've said, passing the challenge and taking your percentage cut. And then finally, aiming for big investors. This is going to be slow and steady, but throughout the long term, even if you do have, for example, proof of, okay, look, I've worked with these prop firms, I've worked with building my own personal account. The one thing that they really do look at is your risk management. Remember, in the whole Forex industry, especially the people at the top, they're not looking to make insane amounts of money. And don't get deceived by people that are making 50% returns in a month. Yes, it's doable. It's especially with lower funded accounts, it is possible, especially with your personal accounts with higher leverage. It is possible, but don't be deceived by this. For me personally, I only look for about a 5 to 10% gain a month. Even that is quite a lot of times. My strategy is very, very simple. I risk 1% per trade, and I try to look for a 1 to 3 every single time. Again, we are taking profits, in between that stage, but it's keeping a very consistent approach and something in the market that we can rely on. Now, just look at the compound growth. Now, let's just say, for example, you're starting on a 100K account. I am not going to compare this to a prop firm account because generally with prop firms, you do want to be taking out your payouts as soon as possible. You don't want to leave it in there just in case something happens with the company. But if we're comparing this to a personal account, for example, and we're starting on a 100K, what can we actually see with a 10% profit? Now, again, I am not trying to say that this is completely possible. If this was possible, I would say that I've done it myself. But keeping a consistent 10% profit return every single month is something very difficult. But simply just to prove to you the idea of the compounding effect, if you start with a 100K account and you're looking for a 12-month, 10% gain every single month, you would have basically made 280% on that account. Now, this is something that's obviously quite difficult to do. And I personally don't know any traders that have done this. I obviously go for more of the consistent returns and much smaller returns, but something still profitable. Now, let's just take a look at prop firms. Now, again, just using the example of 100K. I do believe on a prop firm account, it is very easy. Not very easy, but it's scalable. And, there is opportunity to go for it for at least a few months on every single prop firm. Again, if you are able to hold onto it for much longer, that's an amazing thing. Now, let's just say even with the prop firm space, usually now the standard is about 80%. That's the profit split. But let's just say, for example, you're even looking at 50%, which is quite rare nowadays. If we get a 10% gain on a 100K account, you're looking at a 5K payout. And this is usually from an investment of simply just $500. Now, again, if we scale this up to 200K, maybe even 400K, 600K, I know some prop firms that are doing nowadays, you can obviously scale up your profits immensely. Now, in terms of the investors, with this, it's a lot more flexible in terms of how you approach it. You could simply just show your performance with a legit account, go for at least 12 months or so. Now, remember, the one thing that they really do look at, and I have to emphasize, is risk management has to be on point. Low risk is my advice. Don't be looking at even a 1% risk per trade because, again, few trades in a row and you could be knocked out. What you're going to be looking for is maybe 0.25% risk on every single time or 0.5% risk on every single trade. So yeah, pretty much all they're looking for is that low drawdown and safe gains. That's the long-term view that they want to be looking at. Now, how much money do you actually want to make? This is something that you have to make clear in the beginning. I'm not going to be here to say to you, you're going to be making 10K a month, as soon as you start learning this and start applying this. No, it's all going to depend on what your plan is. First of all, like I said, you've got to have some reserves. Do you have a second income? Do you have some kind of reserves on the side that you can rely on? With me personally, when I did start out on my journey, I literally just started out from a restaurant. When I started on my trading journey, I was in university studying architecture. I was doing that for quite a while and working at a restaurant at the same time. And again, you can understand, you know, I'm from London. You can obviously see the background Canary Wharf over here. You know, working in a restaurant job, I was probably getting paid, what, £7.50 an hour, something like that. Literally just working summers, working any time that I could do outside of uni. I had a bit of investment saved up. That's obviously what I got into. I didn't obviously have to go to my mom or my dad, luckily. But again, this is something that I would advise. Now, let's just say, for example, you're aiming for 5K a month. You know that on a 100K account, you have to get 5% a month. Now, what I'd usually say is this. If you are getting into trading, it's going to take, I would say personally, at least 6 months to get to grips with everything. The reason I say that is because this. 1 to 2 months, you're probably learning and studying all this knowledge. You know, enter the free Discord. You're going to be getting all that knowledge for completely free. I've got so much value to give to you guys over there because honestly, I want to give out as much value to everyone as possible. 5% a month, if you are going to be aiming for that. Again, there are going to be a few months of backtesting and really solidifying your strategy. For me personally, even myself, it comes to times where I still develop my strategy every single time. You know, obviously now, for example, I've been using my elite strategy for over a year now. And when I was testing my strategy before I was in the SMC space, and now obviously I developed that into my own sort of preferences and everything that I've learned over the past few years to help me, you know, to get that win rate up. You know, now even with some of the testing, almost hitting an 80% win rate, and you know, we've got screenshots to show it, and I'll probably edit it and just put it on screen over here as well. It's honestly insane when you test it as much as that, and you really just focus on one pair and you really focus on one setup. That one setup per day is something that's reliable that you can stick to. That's something you really want to be looking for. So, like I said, you know you want to be making 5K a month. You know that your strategy is roughly making you 5% per month. How much are you going to be needing? That's 100K. So again, your goal is going to be looking for that 100K prop firm pretty much in the beginning. Or for example, I don't know if you're a big whale in the industry and you can invest for 100K straight up. Obviously, props to you. You probably are not a beginner in this financial industry. But yeah, that's your goal. Getting your capital size to whatever suffices for you. If 5K a month does it for you, that's basically it. Again, remember, with the Forex industry, this is what is the difference between being an entrepreneur. And I wouldn't say being a trader is an entrepreneur because you're still working. You're still working for yourself. But obviously, you have the leisure of time and, you know, money freedom in a way as well. You also have ways to scale up very, very easily. And the scaling model within Forex is quite simple. You know, you pass one account, you pass the next and the next and the next, and you keep on going with that. Now, getting into the next part over here, the very, very basics. So now we've talked about more of the psychological sort of part of trading and how we can actually make money in the industry. How do we actually get started with it? Now, in all honesty, this part is really going to be a baby pip style. So as you know, there is a website online. It is called babypips.com. Many of you will probably know it. This is pretty much all it's about. But I am wanting to put this into the video just to pretty much explain it to you all. Now, what are currency pairs? Major and minor pairs and pips and measuring them. This is the very basic. So even if you know this, you might just sort of remind you of a few things. So yeah, one thing I will note, if you do want extra reading on the basics, look up babypips.com. It is very, very simple. You know, I would recommend sections 1, 2, 3, 4, 6, and 8. Everything else starts to get into the more strategy side of things and the technical analysis. My honest opinion, don't really look at that. Baby Pips is there for the retail industry. Now, again, I am part of the retail industry as well, but I've broken away from Baby Pips a long time ago. You start to realize when you test these things, RSI, MACD, and a few other indicator type of things, yes, it might work for some people, but for the majority of people, I think we'd unanimously agree it doesn't really lead to long-term profitability. So yeah, it's going to be very, very simple. Now, what major currencies do we have? Very, very simply, we've got the US dollar, the pound, the euro, the CHF, CAD, JPY, AD, and NZD. These are going to be the main 8 currencies that we are going to be looking at. Now, the way Forex works is we put these currencies and put them together in a currency pairs. So as we're getting into all of this, we're going to be pretty much explaining how this actually works. So let's just take an example, USD JPY. Now, what this means is this. If USD JPY is buying up, that means that USD is appreciating, JPY is depreciating. Now, there are occasions where, for example, there is a slight variation, but the general rule that we do look at if USD JPY is going up and in an uptrend, we are expecting that USD is going to strengthen, JPY is going to weaken. Very simple. Now, in terms of minor currencies, we also do have minor currencies in the industry. This is something that you obviously can trade as well. Usually, they are not as liquid as something as Euro USD, for example, which is one of the biggest currency pairs that is traded sort of within the Forex industry. Some minor currencies do include the Turkish lira, the Mexican pesos, South African rand. This is something that I've not really delved into. I personally just stick to a few pairs. My main pairs that I do stick to, the number one for me is Euro USD. This is honestly, it's because I've tested it so much. Me and my team, obviously, we've gone through it for so long, over years and years of data. And now I understand this pair like the back of my hand with my strategy, of course. Again, if I do want to test my strategy on other pairs, that can be doable as well. But obviously, it does come with time. Backtesting is not something that happens very, very quickly, but obviously, you can do over time. Now, in terms of bullish versus bearish, now this is something that's very basic, but you need to understand, what does bullish mean? Simply, and to put this in simple terms, it's buying. This is also something that we call longing. Now, bearish means shorting or selling, and it's very, very simple. So we've got bears and we've got bulls. So whichever way you are, the way I think about it is a bull, I don't know, a bull kind of reminds me of something aggressive. So it's something that really goes up. A bear, also aggressive as well, but yeah, I don't know. This is something that I just had in the beginning. Now, in terms of the currency relationship, like I've said, if, for example, USD JPY buys up, we can expect that. Euro USD, same thing as well. If this buys up, the euro gets stronger, the US dollar gets weaker. Now, in terms of the opposite as well, if this does sell, we can expect that USD sells off and JPY actually buys up. So that's something that you always need to think. USD and JPY will have an inverse effect on each other. So if JPY is buying up, that is essentially going to be meaning that the pair is going to be going down. So it's always the second one that does the inverse and the first one that does the direct sort of, it has a direct relationship. Now, in terms of currency pairs and the nicknames that we actually use, we have got the Euro USD, which is called the fiber. We've got the GBP USD, the cable, and then obviously so on and so on. This is something that a lot of traders refer to. If you search up any fundamental articles, this is pretty much the way that they refer to it. So very, very simple in terms of that. Now, in terms of Forex currency quotes, now within the market, you're going to be quoted a price for the currency pair. Because think about it, the currency pair, you're actually trading euro for US dollar. Now, it actually has intrinsic value. Now, I'm talking about the spot Forex market. I'm not talking about CFDs. There is a difference here, and we're going to be talking about that later on. But when it comes to the spot Forex market, it's something that we're actually trading. Now, this is something institutions do. The reason banks, like as you can see in the background, just over there, Citibank and HSBC Bank and Barclays and everything, when they are trading and they are trading currency for currency, they are actually physically trading the euros for US dollar. Now, this doesn't mean that they're actually trading cash hand in hand, but it means obviously across from bank to bank, interbank transfers and everything is something that they're actually trading. So it has intrinsic value. Now, when we're looking at the actual Forex currency quote, we're going to be looking at something like GBP USD, for example. It's represented as 1.25. This means for £1, you're going to be receiving $1.25, $1.25. So every time you have that conversion, obviously that's what you're going to be getting over here. Now, as an example, how does the Forex industry actually move and how do these prices actually move? Now, if we're starting off with GBP USD and we're moving from 1.25 all the way up to 1.255, pretty much we have raised just 50 pips. Now, you might be wondering, what is actually a pip? Very, very simple. The pip is a percentage in point. It's basically a unit in measurement. Something very simple that we use in the Forex market, basically to identify how much a Forex pair has moved by, or let's say a commodity pair or whatever it may be. Now, as an example, we've taken a look at GBP USD and also GBP JPY. Now, 1.2507 is the quote we've received on GBP USD. The fourth decimal place is pretty much what the pip is. A pipette is what we're going to be talking about afterwards, but there is an exception for this rule. In general, for Forex pairs, we are going to be seeing a pip is going to be the fourth decimal place, but the exception here is for JPY pairs is going to be the second decimal place. So remember, if you are trading, make sure as a beginner to take note of this, and obviously you will know not to mess up with any of your pips. There are also exceptions for commodity markets and indices and everything like that, but again, In general, we're talking about Forex trading over here. Now, what are pipettes? This is pretty much a tenth of a pip. So this is the 5th decimal place on the usual Forex pairs, but this is the 3rd decimal place for JPY pairs. So very, very simple. Now, in terms of a summary, most retail traders will stick to the 8 major currency pairs. Now, we do not need all the combinations. We only focus on a few. My personal preferences are Euro USD, GBP USD, and at times GBP JPY as well, just depending on how the market is moving. The reason I say this is not because I simply just plucked it out of thin air, but it's because I've tested it. And that's the one thing I urge every single person to do. Now, remember, your focus is a lot more important than simply spreading yourself out thin. I always advise people stick to only a few pairs, maybe 3 pairs, maybe 2 pairs, rather than looking at the whole broad market and maybe even looking at 18 pairs or so. It's something that I would advise against, especially in the beginning. Now, moving into the next part over here, we have got margin, leverage, and brokers. This is actually getting into the market and understanding what does our money mean and how can we actually put it into places so we can actually trade. Now, in terms of margin is essentially how much of your capital is currently being used up. Now, once you reach a certain limit, your free margin will eventually go to 0 and you can no longer add more trades. Now, this margin is also determined by how much leverage your account has. Again, the usual leverage that we do see on CFD accounts these days is something between maybe 1 to 20 all the way up to 1 to 200 at times. Again, in the US, I know they've always been, reinforced by laws and everything. So the leverage over there has always been lower. Again, it is being lowered in other countries as well. But leverage essentially helps you to raise your initial investment and pretty much exponentially increase it. So if you've got a 1 to 200 leverage, imagine you're trading with let's say a $1 account. You have the capability to put on trades that a $200 account could put. It's very, very simple. That's pretty much all we're going to be understanding from leverage and margin. Now, the main difference that we're going to be talking about here is this. When we're looking at spot Forex accounts, usually you are provided none to little leverage. You are actually trading currency pairs. And the difference between this and CFDs is a contract for difference is pretty much a contract that imitates what a spot pair actually looks like. So if you are trading prop firm accounts, don't think you're actually trading the live markets. Your trade, let's just say you were to put 100 lots in the market, or let's just say 1,000 lots into the market, your CFD position is not going to impact the market at all. But if you are trading spot Forex accounts, obviously that is going to be different and you are actually impacting the market. Again, if you do have smaller accounts, usually are not going to be impacting the sort of the market as much, to be honest. But again, this is the difference that you need to understand. Now, in terms of brokers, now for you to trade the Forex markets, you can trade MT4, MT5, but you need to invest your money into a broker. Now, the broker, let's just imagine it as a bank. For you to actually get money from your job and invest it into somewhere, your bank basically holds the money for you. Now, again, there is dispute about how much money they actually keep in their banks and everything. But again, it comes to the same thing as a broker. It acts in the same way. You put your money, your live capital into this broker so you can actually trade the live markets. Now, there are going to be a few options. I've basically just recommended TradingView over here. When you go into the panel sort of down below on TradingView, you can basically access this and look at any of the markets that you can access over here. You can open up demo accounts, you can open up live accounts as well. So obviously here's just a list of brokers that you can access. So I hope that makes sense. Basically, you need to put your money into a broker. Now, part number 4, we're talking about the trade composition and positioning size and lot sizes. So this is all about how we actually get into the trade. Now, when you enter a trade, you always have 3 things. You have the entry price, the stop loss, and the take profit zone. These are 3 things you always need to keep in mind. Now, there are gurus out there that actually recommend to you to not even have a stop loss, especially if you enter these dodgy Telegram groups where they say invest into this account and we can basically give you signals for the month and you can basically trade it. A lot of them people are scamming you. I'm telling you right now, be careful, especially when you're getting these trading ads that come up there and they recommend this type of stuff. Always have a second look at it. Especially if they're not recommending any stop losses. But pretty much on the charts, this is what it's going to look like. You have your entry, your stop loss is just going to be above over here, as you can see, and then your take profit is going to be where are we actually going to take out our position to take some profit and put it into our pocket. Because again, remember, the whole goal here It's to actually make money in the market. It's not to become the best analyst in the market. It's all about making the money. So just in general, how to actually use TradingView. When we're looking at stop losses over here, we're looking at 10 pips, right? So a 10 pip stop loss is going to be represented over here. It's going to be the third part over here. So 10.0, as you can see over here. Now, the next part is going to be the risk to reward factor. Now, in this case, the risk to reward ratio is going to be 2.5. So this means for every, let's just say $1,000 that I can lose on that stop loss, I can gain 2.5K or $2,500 on that same position. So again, long term, what you want to be doing is you want to make sure that your gains are more than your losses. Now, again, there are traders out there that trade with a less than 1-to-1 risk to reward, obviously because their win rate is very high. I try to balance it. Now, my usual win rate is around 70% or so. More recently on tests we've done, increased it up to 80%. So we're just trying to get that more as an average. But again, I'm basically looking for a 1-to-3 risk to reward. And that is as simple as that. There are traders that out there that are looking for, let's just say, a 1-to-10. But again, you must understand their win rate is a lot lower. 15%, 20%, 25% I've even seen from other traders. It is profitable, but in the long run, it really does affect your psychology. And for me personally, I like to go for that, that decent win rate, 70 to, let's just say, even 80% in the more recent tests, and look for that 1-to-3 risk to reward. Now, in terms of the pip count, again, it is going to be similar to the top. So 25 in this occasion. So we are looking at 1.25 risk to reward return. Now, in terms of lot sizes, what does this actually mean? So Forex is commonly traded in specific amounts called lots, or basically the number of currency units you will buy or sell. Now, a lot is a unit measuring a transaction amount. Now, a lot can be defined by 4 ways. You've got standard, mini, micro, and nano. Now, in terms of the number of units, for a standard lot, we can have 100,000 units. For mini, we have 10,000, and then obviously we've got micro and nano. Usually, brokers are either going to be trading with mini or standard, but this is the type of thing, obviously, you have to look into your account just so you can make sure. Now, how do most brokers actually show this? As you can see over here, when you do open up a position on MT4 or MT5, this is pretty much just an example of a screenshot I took online, for example. But when we are trading that, as you can see over here, we have a 1 lot size over here. So a buy 1.00, that is going to be the lot size. So usually what this means is 1 lot is going to transfer to 100,000 units of that. So we have transferred 100,000 units of pounds to dollars. And it's as simple as that. Now, in terms of calculating your position size, this is very, very important. And this is probably one of the things that traders need to understand in the beginning. If you skip this part, genuinely, you are going to probably blow accounts. And it's obviously not something that you want to be having. Now, the best place to actually measure your lot sizes is going to be this. It's going to be FX Book. Or as you can see, the link is over here. Very simple. All you're going to be doing is this. The currency pair, you're going to be putting that at the top. The account currency, so I obviously trade in an English account, is going to be GBP, for example, or if it's a profit account, usually USD. We're going to be putting our account size over here, as you can see, £100,000. And then in terms of our risk percentage, usually going to be going for that 1% risk. And then as you can see, the stop loss, let's just say we put 10. Trade size lots, usually we would keep this, the same, just one. Basically, this will be represent the standard lot. And then in terms of our actual calculation, as you can see, our sizing over here, the most important part, 12.13 lots. That is basically the position that I'm going to put into that trade. Now, moving on to some of the later stages of the beginning part of the course, we're going to be talking about types of market orders. Now, this is going to be something that every trader needs to understand. We've got market execution, buy and sell limits, and buy and sell stops. So the market execution is as simple as this. This is when you get into the market immediately with a direct sell or buy order. So this is an example of one of my trades that I've taken recently with the team. And pretty much what it was a market execution. So I told them, look, guys, I'm looking to get into Euro USD shorts and pretty much get prepared for it. Now, as you can see over here, it started to sell off, and pretty much this is what it looks like. So when you are on your MT5 or MT4 platform, you press trade and you pretty much get into it. So you can determine it over here, market execution. You click that little icon over there. You put your stop loss, take profit, and then obviously your lot size over here, and you click buy or sell. Obviously, don't be a fool and click the wrong one when you're trying to buy and you actually press sell. Obviously, I've seen traders even do that as well. And sometimes it actually came off because the analysis was wrong, but the trade actually just went their way. Now, in terms of limits, this is basically when you can expect price to reverse at a certain point. So all we're going to be doing is setting it at a certain area. So this one's a slightly more complicated. We put it at a price, stop loss, take profit, but it's still very simple. And then stops, so buy stop / sell stop is going to be simple. If we expect price to run through a certain area, all we're going to be expecting is put a price. If it runs down there, boom, it's going to be entering. So very simple. Now, how do we actually analyze the charts? Now, TradingView is one of the most trusted platforms. Globally, it's probably one of the #1 charting platform out there. And honestly, even the premium products are worth it. You know, I would say this, obviously, when I started out, I didn't have much capital, so I just used the free versions. The premium obviously helps you to set a few more things that really do help you with trading, whether it's limits, sort of signals in a way. You know, you can actually wait for price to hit a certain area and it will actually notify you. That's one of the main things. Also, you know, diversifying your charts and basically looking at, you know, different commodities, indices and everything. You can all put them on different watch lists. But yeah, guys, it's going to be as simple as that. So this pretty much concludes chapter number 2, you know, looking at some of the more basic parts. And yeah, if you are a complete beginner, again, I always recommend go back into my free Discord. I am going to be putting that over here. The link is going to be in the bio, and obviously you can look at that over there. Now, getting into the next part, chapter number 3, it's all going to be about the technical analysis and the beginning stages of it. Now, the one thing I want everyone to understand is this. There's 2 core concepts that we have to stick to within trading. The first side is this. You've got the fundamental knowledge and then you've got the technical analysis. Now, the fundamental analysis is the true analysis of why the markets actually move in a certain direction. You know, just taking a look at the background over there, Citibank, do you really think they're trading and actually moving assets from GBP to US dollar just because of one technical piece of analysis? No, it's because of the fundamentals, and that is really what moves the markets. This is why I say the stepping stone to the market is obviously understanding technical analysis, but really understanding fundamentals, which is why I taught it, why I've been teaching it to my premium members. You know, it's something that, you know, if you understand fundamentals, you really are going to know where the market is moving. Why is it moving there? Then all it takes for us is to get our technical analysis knuckled down, and then we can finally get into the charts and basically get into our positions. If we know, for example, the chart is going to move in a predestined location, you know, if we know, for example, Euro USD is going to drop off for the next 6 months because of interest rates, we know that, okay, now all we're looking at is maybe a slight pullback on technical analysis, and we can basically get in. So that's one thing I want you guys to never forget. Fundamentals is what moves the markets, and don't be tricked by anyone that tries to tell you otherwise. Yes, my strategy is built on technicals, but we have that fundamental knowledge to understand when can we get into the markets and when can we not. That is a complete strategy. Now, in terms of fundamental analysis, I'm not just going to tell you, right, guys, fundamentals is important, but not direct you anywhere. I'm going to give you some knowledge. The core components you need to understand for fundamentals. The first one's going to be interest rates. Interest rates is the most important thing because, again, it is, you know, the pretty much the thing that defines why a currency pair is at its price and why another currency pair is at its own price as well. In terms of GDP, inflation and employment, these are obviously the next most important things as well. But again, there are different themes at certain times. So for example, a few years ago when, you know, the whole pandemic was happening, interest rates were at a very different level. Now, for example, when there's a recession, the interest rate scope is very, very different. So we must understand, how do these 3 things afterwards, GDP, inflation and employment, play in reference to interest rates? This is something we get into more detail, obviously at other times as well. But again, if I wanted to direct you into these 4 main areas, these are the 4 main things that you are going to look at. Now, in terms of technical analysis, as we know, technical analysis is simply just the study of price action. Now, within the industry, there are many styles that you can learn. You know, we've got indicator style technicals, we've got retail, and we've got smart money concept style. These are the 3 main that I define, especially now in the retail space. This is pretty much what you're going to be doing. For me personally, I mainly come from an SMC background. You know, this is where I did start off. Or actually, I started off with retail back in 2018 when I was learning it. But when it comes to SMC, obviously, I have developed from that, you know, coming up with my elite strategy and everything. This is something that, you know, again, it is the core concepts of what I base it on. But again, I personally feel that if you find your edge through backtesting, through everything that we've talked about in the beginning, you could really find that profitability. Just relying on a few order blocks and fair value gaps is not going to do you justice. Now, what do I need you to understand? Fundamentals overpowers everything. I think I've put this into your head enough now. Now, through experience and many conversations I've had with many traders who have been in the institutional side of trading, technical trading is simply just a way to manage their risk. That is the simple definition and the simple answer. Their main approach is long-term views into fundamentals and getting into these positions, of course. Now, is technical trading profitable? Yes, it still is. Now, trading, you can basically technical trade any single strategy and you still will be profitable, yes. But there are going to be many times, and I've seen many people be wiped out just because of their technical analysis, because they don't understand what the fundamentals means. What does it mean when an interest rate actually increases? And what happens when inflation is high? These types of things, you really do need to understand at least the basic knowledge of it, and then you can apply it into your technical analysis. Now, master these 3 things. What you need to master: trading strategy, psychology comes second, and then risk management comes third. Again, you can swap and change any single one of these, but for me personally, I always feel like the trading strategy comes first, just because it's something that, what's the actual content that we're basing it off? The psychology is something that you need to have across your life. This is something that I've talked about on a podcast recently as well, going to be coming out quite soon. But psychology is one of the most important things that I stick to. As soon as I have my main 5 core concepts outside of my trading that I stick to, this is something that even helps me within my trading and my psychological sort of, movement. I don't know what to say. Number 3 is going to be risk management. Without risk management, you're going to be a failing trader. Very, very simple. This has to be like the foundation of your trading. If you don't have risk management, you're not going anywhere. Honestly, just quit trading right now, which is not something you should be saying. Now, what will you actually learn in this course? Now, I can only teach you so much within one webinar series. I can only teach you the trading strategy. Now, the psychology, this course is only the start. One thing that's really going to help your psychology is joining that free Discord. Again, I'm not trying to sell you anything over here. It's simply for free. If you want to join, you can join the free community and everything. You can join like-minded traders. I know there's so many people that will come from this video and basically go into that and, want to actually understand the psychology, and, just being around like-minded people will really, really help. Now, in terms of number 3, we've got risk management over here. Now, in terms of risk management, like I said, this really is the foundation of your trading, and you can never skew away from it. You have to stick to it. Me personally, I always stick to a rule: 2 trades max per day. 1% risk per trade. If I lose more than 2 trades a day, I'm out, because that signifies to me that it's not the optimal market conditions that I'm looking for. Again, my win rate is, usually much higher than most people, simply because I look for 1 to 3. Obviously, I've backtested my strategy just so many years on just one pair, then the second and the third, and obviously now I know it like the back of my hand. Now, what can help build your psychology? This is the part that most traders actually struggle with, because they know the knowledge, they know the information that they need, but when it comes to the live markets, they actually struggle. Now, what will I do? By the end of this course, I will get into some of the more psychological aspects to improve as a trader, and actually actionable tips that you can implement. So yeah, pretty much that's going to be it. Now, in terms of types of strategies that we're going to be looking at, it's going to be split up into 4 main types. You've got scalping, day trading, swing trading, and position trading. Now, the first one's going to be scalping. This is pretty much where you're focusing on the 1 minute or less. Some people are even second traders. Me personally, I think a 5 minute is perfect for me, especially for my strategy. The duration is only going to be less than a few minutes, so you're either going to be hit and take profit very quickly or being wiped out very, very quickly. Target 10 pips or so. Day trading, 5 minute chart or the 15-minute chart. Duration is going to be less than a day, and target up to 50 pips a day, just based on what the ATR is for your trade. The ATR is pretty much just basically how much the currency pair usually moves around that time. So you can set it to the last 7 days, to the last 14, 30. You can see the average of how much it moves. Swing trading, this time frame is going to be 1 hour and 4 hour. The duration is usually going to be days or hours. And then we've got the target, 50 to hundreds of pips. This could be plus 500, whatever it is, depends on how many days you are holding it for. Now, again, when it comes to position trading, this is something that I personally don't do, because again, for me personally, I am a retail trader. So it's not like I've got millions in capital, that I can be trading. if you do have, these institutional traders, they're managing massive amounts. So for them, they don't want to play the riskier plays. They want to play something as a position trade, something that's understanding fundamentals, for example, and then obviously just looking at simple technicals to get into their charts. Again, when it comes to this, these are going to be macro moves. So for those of you that are trading on lower time frames, this really is not going to be applying to you. Now, in terms of top-down analysis, no matter what strategy you use, you always start your analysis from the high time frame. Starting off from the daily, the 4 hour, 1 hour, 15 minute, then the 5 minute. This is basically what I go through. Every single week when I'm doing my weekly analysis, I always start from the 4 hour. I go down to the 1 hour, look for my points of interest. Then on the 15-minute chart, when we get close to that time of day, that's basically when I start to look for entries, and then I execute on the 5-minute chart. Now, setting the actual foundation of your strategies. My top 4 things that you need to master: market structure. This is king. When we're going to get into technical analysis in the next chapter. Market structure is number 1. It trumps everything else. If your market structure analysis is wrong, most likely you're going to run into trouble. Number 2, liquidity. Understand where markets are actually moving and where money is flowing. Understand that liquidity rests above certain areas and it rests below certain areas that have to get taken. And we're going to be talking about that in a lot more detail. Number 3, supply and demand. This is pretty much where we look for our points of interest. So order blocks, fair value gaps, anything like that. And then number 4, we're going to be talking about timing and other confirmations. So guys, it's going to be very simple. Finally, this is going to be the last thing that I'm going to be talking about over here: risk management. If you are not sticking to risk management, forget this entire video, forget all the education I've just taught you. It's not going to be applying at all. You have to stick to that 0.5% risk / that 1% risk. You have to stick to it. If you do not, you run into failure, basically. You're going to be overexposed. One thing I will say about risk management: don't overexpose yourself on multiple pairs that have the same currency. As an example, Euro USD and GBP USD, it's going to be moving quite similar. Added to that, AUD USD, NZD USD. Again, when you get into something like GBP JPY versus, let's just say, Euro GBP, again, there can be quite a difference, but still, you are exposing yourself to the similar type of moves. So guys, that's going to be it for the introduction to technical analysis. Remember, foundation trumps everything else. It is the core of why the markets actually move. But yeah, just keep that at the back of your head. And that's going to be it for this little chapter over here. And so we're finally getting into market structure. So this is going to be, honestly, king above everything else in terms of technical analysis. As I've mentioned, whenever it comes to mastering any analysis, you need to think of these 4 things: market structure, liquidity, supply and demand, and obviously all your final confirmations at the end. But the number 1, it has to be emphasized, is market structure. The reason I say this is because markets move in trends, right? Now, we need to understand when we are moving in a trend / when we are having a reversal. This is very simply put. The 2 main core concepts that we have is we are either trending, we are either reversing / also in consolidations as well. Now, we need to understand where we are in the market and how we are actually going to be moving. So in this chapter, pay attention, especially start to take notes now if you have not been taking notes. Now, in terms of the best trading environments, trendy environments are much better to be trading within because we have a clear direction in our frame of mind. Now, areas of consolidation tend to create more difficult conditions for traders, which obviously should be avoided unless you are trading a specific strategy within a range. Now, again, I know obviously some range traders or some consolidation traders, but again, most traders find themselves finding themselves profitable within a trending environment. And it's very simple, just thinking about it. If, for example, you are trading stocks, let's just say, long term, you understand that I would be much more profitable investing in a certain asset that will be appreciating, rather than giving some consolidation and I would have to be in the market, out of the market. That's basically what we're looking at over here as well. Again, I have to refer back to what I talked about in the previous module. Fundamentals trumps everything. So the reason why we move in trending environments is because of fundamentals. But our understanding of technical analysis is all based off, first of all, market structure. Now, the whole theory behind it is very simple, and I'm going to be putting this in very beginner terms. The theory is that trends move like this. We have higher lows, higher highs, higher lows, higher highs, and higher lows. If we have a continuation of these areas, we know that we are within a trending environment. Now, the reality is this. we know that it's much more complicated in the live markets. It's not as simple as this. Again, we do have scenarios where this does happen, and we do have to capitalize on these type of environments. But the reality is that as price moves upwards, we have a low, a higher high, a low. Again, we could get a higher high, but price could also come down to take these lows, sweep that liquidity, and continue to the upside. Now, the main point is here. We have to look for trends. We look for continuation of a few points in bullish structures. So our previous high is continued to be broken through with break of structures, and our significant primary lows are not broken. Now, let me just refer back to that very quickly. Our higher high has to be broken again, and our higher low has to be respected. So what do I mean by respected? It's not breached at all. Now, we are going to be talking about a slight variation of this where we can still have it breached and still continue to the upside. But obviously, stay tuned for that a bit later on. Now, just back to this over here, an important point. Once a high has had a break of structure, we can expect a pullback. Prices do not just continue upwards. Again, we can expect that in crypto markets and sometimes some insane sort of stock markets, and even, for example, when we have big fundamental moves. But we always have pullbacks in any market we are in. The reason we have that is, imagine this. When you are investing into an asset class and price is now appreciated and you are happy with your profits, what are you going to do? You're going to sell your position. Now, when you sell your position and you're trading spot Forex, you're not just selling it as a contract. You're actually selling it to someone who wants to buy that position. So the whole point of trading is this. We buy low and we sell high. Very simple, because we want to make a profit. Again, let's just say, for example, you are in a restaurant. You want to buy your supplies low and you want to sell it for a much more premium price. It's very easy to understand. Again, very simple over here. As we break a new high, we expect price to pull back. Now, the second part is this. The best place to enter is once the pullback has actually reached a discounted area. So now we're looking at premium versus discounted areas. Now, what are these? Premium and discounted areas is something that we also use in real life. So just like that example over here, if we want to buy something, we want to buy it on a sale, right? So let's just say, for example, I just bought this shirt. If, for example, it was priced at £200, but there's an offer at £100, of course, I'm going to be grab up that offer. And if anything, when we see that price actually reduce, it allows traders to really have that, okay, let me get into it. But the problem with the Forex market is you don't always know where that price can always decrease down. This is why we have risk management, why you have to have your stop losses. It all makes sense at the end of the day. Now, within SMC, you would usually define something as discount when it is below 50% of the Fibonacci retracement. Now, we are going to be getting into an example. However, if you want to make this a much more effective, you look for zones anywhere below the 61.8 retracement. Very, very simple. This is what we're going to be looking at. So as an example over here, as you can see, pretty much this is what an example of a market. And I've actually taken this from a live market and basically replicated it in terms of price. We had a very simple breaker structure up here. So we are now bullish. And as you can see over here, price starts to push downwards. As you can see over here, we have now reached a discounted area. So I've put a fib retracement from the start of this leg all the way up to the top. This red line represents the 61.8 fib retracement. I say 61.8 fib retracement because it's a golden zone. If you search this up, 61.8% in real life, you know, this comes in natural forms as well. This is something that is replicated over and over and over again. It also replicates itself within the Forex markets. Now, how do we actually enter this? We're going to be talking about this in future modules. But for now, understand that we are only looking for prices to enter discounted areas or sell at premium areas. Now, selecting our points of interest. As always, I recommend look for your point of interest only within these premium/discounted areas. The reason I say that is because of this. Let's just say, for example, somebody was going to enter off of this support zone or this support or resistance zone or breaker zones, as many people would call it. Because it's quite high up in terms of the range, it's not past the 61.8 fib retracement, price is likely to return back down here. Now, again, there are times where price does exceed this area, and so it hits that breaker block, for example, and just continues upwards. That's when you have to understand why fundamentals are so important. This is why I always keep my students updated with this fundamental AI that we've invested in recently. And You know, it's quite pricey, but obviously it does work quite effectively. We understand where price is not destined, but is going to move towards, and the likely scenarios that we are going to be seeing. Now, again, with points of interest, I always recommend look for these in the discounted areas, obviously in a buy trend. Again, like I've just said, it's not to say that it happens every single time, but very rarely, you know, it retraces all the way. So we have to enter at a decent position in a way. Now, the next thing, let's look at break of structures / change of characters. Now, what are break of structures? Break of structures are very, very simple. It's basically when we exceed the previous high. So say, for example, we've got over here, a break of structure is when we break that primary high up there. So price exceeds upwards. Now, a change of character is the opposite. Change of character is when we were in a bull trend, so we were trending upwards, and then finally, price is actually starting to break downwards. What this proves to me, and obviously other traders as well, is that price is now intending to move to the opposite direction. Very, very simple in that scenario. Now, in terms of step one, identifying highs and lows, what are we going to be looking at over here? In terms of highs and lows, always, I would recommend, if you are a beginner, try to identify these, because you can start to see where the trends are in the markets and where, most importantly, it starts to shift. Now, let's just see over here. Where do we have break of structures and where do we have change of characters? First one that we see here over here. As you can see, this higher high had the break of structure up top. So we're still on a bull trend. As you can see over here, we had a higher low. For now, up until here, we're still in a bull trend. So we can expect this to get taken. However, we got a lower high over here. Then as soon as we had this change of character, that's when we're in a downtrend. And that's when we can start to look to the other side. Now, as you can see, price starts to move downwards. We have that retracement up to that discounted or that premium zone. We sell off up until at least this break of structure. Once that break of structure happens, we now know we are in the downtrend. Again, we now refer this to the other side as well. Change of character over here. Now we start to have a higher high, pullback all the way down to the discounted area, higher low. Now we can start to actually move upwards to this break of structure. Remember, the way the markets move is always in waves, is like how I like to call it. We exceed, we have trends, we have consolidations, then we have further trends, whether it's to the upside, whether it's to the downside. This is how we understand everything very, very clearly. Now, how can we actually use this? If I expect a trending condition, you know, and we're moving upwards, simply all I look for is a pullback to take us up to the next break of structure. So usually this will yield you a very good risk to reward. This is something that I even use in my personal trading. One of my take profit zones is always at the break of structure area. Now, how can we use the change of character area? If we see a change of character, we basically take our entry at the pullback after the change of character. So remember, we don't know at this point over here. Let's just forget, for example, that we have this price action over here. If we are at this point, we can expect that we are still in a buy trend, right? But it's only when we get this point over here, we reject off an order block or a supply zone. And then as soon as we start to exceed downwards, once we get this break down here and we have that change of character, that's when we're in the downtrend. So the next point that we must understand about market structure is, and quite possibly one of the most important, strong and weak highs and lows. Guys, please, if you have come up to this video up until this point, please leave a like and a comment below. I'm doing this and it is quite a long webinar and completely giving it out for free. So I hope you appreciate this, and you know, you can just give a bit of feedback. It really does go a long way. Now let's get back into it. Primary and secondary structure. Now, in terms of primary structure, we generally define this as the last significant high or low as part of the market structure. In an uptrend, this will be the last significant move down before making a new high or making a break of structure. Secondary is the smaller pullbacks and trading movements in between these larger impulses. So remember, when we're talking about larger impulses, so let's just take this book as an example, as a trend. Like, I'm just using this as an example over here. We pretty much would move from here to here. Now, in between these areas, we are going to get smaller movements. But the major zone, this primary low and this primary high, is what we're going to be looking at. Very simple. Now, the significance of structure. How do we actually define this? Again, there's so many moves in this, but we must consider, where are we looking at the significant break of structures and what was the low before that happened? So in this example, we have a low over here. a higher high here, higher low, higher high, higher low, higher high. Here we have a higher low as well. As soon as we get here, we can't confirm that this is a high at all yet, but as soon as it breaks down, we can confirm that that's a high. So essentially, we can now assume that we have now had a change of character and price starts to move the other way. Now, in terms of secondary structure, again, it's just basically going to be the little points in between these large impulses. Now, always remember, primary structure will always hold more weight than secondary structure. The reason I always say this is because if we respect our primary highs on the high time frames or whichever time frame we're on, we are never going to be stopped out. Oh, no, let me take that back. We are going to be stopped out, but the likelihood of that is much lower. Again, that's how I've been able to obtain an 80%, up to an 80% win rate on some of the backtests on even my strategy as well. Now, this is something where we're getting into more advanced topics, the importance of candle closure. This is very, very important if you want to become more of an advanced trader. Now, the types of candle closures that we do actually see. The first one is this, a weak break of structure. Now, we can expect this to not hold up. What do I say by this? The break of structure, as you can see, we've come up. We've actually broken up. But the difference here is that we've actually had a wick, as you can see over here. So this candle over here is something we're going to be talking about in more detail later on when we're talking about the candles and everything. Pretty much there is a significance in candles. We do have the body, we do have the wicks. Now, if, for example, we have taken a high, but there's only been wicks that have taken it, this is a weak break of structure. Again, price can still continue to the upside, but in my head, this basically gives me an indication that liquidity has been swept, and now we can potentially move to the downside. Now, a strong break of structure due to the candles closing up can expect more movements upwards. What do I mean by this? As you can see over here, a clear body closure just above this recent high. Valid break of structure example. Let's just take a look at this example. As you can see, a clean high over here and a massive, nice little break of structure up top with a body closure. So one candle, two candles, that's good enough for me. So all I'm waiting for now is a return back to the low over here, some kind of point of interest, whether it's the fair value gap, whether it's the order block, I'm now going to be entering. Now let's look at an invalid change of character example. As you can see over here, this high was over here. We've now taken this low, but rather than actually closing above this area, we had a wick. And that for me is a clear indication that we're still moving downwards. And that is basically it in terms of market structure. So this is one of my most important lessons. Primary structural highs and lows, secondary structural highs and lows, and then also how do we have these candle closures? If you understand these two things, you will honestly go so far with it all. So that's going to wrap up market structure over here. Remember guys, if you do want to receive more and more value, I am going to be putting down the free link to the Discord down below, and you can obviously access all of that down below. This is all completely free, just complete value. So guys, I'll see you all in the next module. Okay, so we are finally getting into the nitty-gritty part of the course. Now, honestly, if somebody was to ask me what is the real difference that you've made in the past 1 to 2 years, and it's all about liquidity. Now, I've always had an understanding of market structure and everything, but it's once I started to really implement the ideas of liquidity and how to actually, react from certain areas and do everything, that's when I saw my win rate going up. So pay attention to everything, and please, for the sake of it, this entire video is coming out for free. Plus the free Discord, plus everything that I've given out in terms of all of this value. So please, even just like and comment below. I'd really appreciate it. Would go a long way. Now, in terms of main types of liquidity, let's understand the fundamentals of it all first. Now, liquidity is essentially the level of supply and demand of orders in the market. Now, as you know, the Forex market moves based on supply and demand zones, or supply and demand of that particular currency. Now, again, because this is a liquid market, and especially when we're talking about the spot Forex market, not the CFD market, but the spot Forex market, that's when actual transactions are taking place. So if, for example, a bank in Saudi Arabia is transacting all the way to a bank in England and they're transferring their currencies, they are physically changing one currency to the next. Now, with all of that, it's a massive transaction, and this does play an effect on the market, especially considering the amount of orders that come through, with these massive sort of requests from certain banks, from certain companies and everything. So we must understand where Does price actually seek this liquidity? And can we actually spot this in the market? This is something that we've been able to do with technical analysis. Of course, there is something called order flow, which is a much more complicated issue that we can talk about another time. But for now, we'll be talking about liquidity for now. In terms of technical analysis, this is pretty much where we can see orders lying. Now, we have a few ways to actually identify it. The first way is this: buy side and sell side liquidity. This is pretty much as simple as looking at where the highs are and where the lows are. Particularly when we're looking at primary highs and primary lows, is going to be very essential, because we know that in a trending market, we can essentially expect that, okay, we're buying up, we can expect that price will continue up until that high. Essentially, liquidity will be resting at the top. Once that liquidity is taken, we can expect a take profit to be taken at that zone. Now, liquidity type number 2, we have got equal highs and equal low liquidity. Now, in terms of all of this, is very, very simple and easy to spot in the market. It's all going to be about two areas that link up with one parallel line in a way. It's going to be quite simple when we look at that, or one horizontal line. Once we see that, we can understand that, okay, price is most likely going to breach that area, and then we can potentially react from it. Number 3, it's all going to be about trend line liquidity. Now, this one is not something we see too often in the market, but when we do see it, expect that something major is going to happen. Now, a lot of retail traders do use this as their actual strategy. What we do is the opposite. We use them as liquidity. So this trend line, we expect for it to get breached at some point. They are pretty much expecting that price will, it will simply just bounce off of it again and then continue upwards. The way we are going to use this is, once we get to a point of interest up top that's very feasible, and let's say, for example, we have an institutional point sitting there, an institutional number and a few other confirmations, we can expect that, we'll react off that point of interest and breach all of this trend line liquidity. And again, a few examples over here. Now, in terms of the next part, liquidity sweeps. Now, this is something that traders are getting to understand more and more these days. And this is why I'm personally putting out this whole course out there for free, because I believe that no one should really even have to pay for this stuff. There's so many times where people are paying $500 for a course that you could literally see online. And what I want my course to do, what this one to do, is so no one ever has to pay for a course again. Hence why I'm giving everything away for free. So, inducements, what is this? Now, once liquidity is formed in the market, understand that these areas are very sensitive. Once price takes this level of liquidity, it has ultimately achieved its goal of reaching there and filling some orders. Now, at this point, that's when we can often see in the market that we'll hit that liquidity, sweep it, essentially induce it, and then reverse the other way. This footprint is something that I've personally built my systems on as well. And again, even when it comes to some of my algorithmic systems that I'm currently building at the moment, that's something that we've really been working on. Finding these liquidity points and really using it to our advantage. Because understand this, once liquidity is taken, we can expect a sweep or a reversal at some point. It doesn't have to be instant, but at some point. Link that to a point of interest and boom, you have a strategy. Of course, there's so many other things, but that's the basic concepts. Now, in terms of a liquidity sweep model, this is something that we can actually use. As you can see, trendline liquidity linking up here and on the bottom as well. What we would look for is a sweep to the top. Now, what some retail traders actually look for is a break up above this, return to the sweep, and then a continuation. Now, this is something that can be quite faulty, simply because, it's something that, it's an idea that's really taught to the retail market. But when you actually backtest it and everything, how many times does it actually work? We've got to put so many other confirmations in line before we get into anything. Hence why when it comes to my elite strategy, I have a 5-step process. This is something that I stick to every single time. Just to give you a little insight as well, for example, I look on the higher time frames for bias, macros, fundamentals. I look for timing of day as well, entry confirmations based on certain price action, and also a few entry models as well. So it's quite simple when we do look at it. In terms of a liquidity sweep model, this is possibly one of the best. Why? We have a change of character over here. So that's step number 1. The second step, we have a continuation, breaker structure over here. So we have rest in liquidity at the top. Then price is exceeded to the upside, created that equal high. As price starts to move downwards, it has a bit of consolidation. So we're in a bit of a range. What can we expect? We've had a change of character. We're downtrending. We have equal highs to be swept. And we also have an untouched point of interest. For me, this is possibly one of my best A+ setups, just basing it on smart money concepts. However, when it comes to my elite strategy, for example, that's when I do look at things in a bit more detail. But this is pretty much one of these scenarios where if you see this in the market, trust me when I say you do not want to be missing it. Another example, it's the same type of concept. We have a change of character to the downside, some kind of trendline liquidity at the bottom, an untouched point of interest up top, and then we basically start to look for our entries. So if you want, screenshot these areas. However, I'm also going to be posting these in the free Discord group, so you can have all of these slides for free. And yeah, basically you'll have access to everything, really. I'm giving everything away for free. So the next part, reactions at points of interests. Now, the point of interest reaction type number one. When we have a point of interest, we can react to it in two ways. Type number one, it actually mitigates the zone and comes straight down. This is typically what we'd see as the most reliable type of entry. You know, once we get this, we understand, okay, this point of interest has mitigated and now we can basically just enter the market. Type number two, this is where we can still rely on it, but obviously we have to be a bit careful. Now, the reason I say this is because of this. Going back to the last module, and if you haven't watched that, skip back to that as well and then come back to this area over here. As you can see, it's very, very simple. All we look for is this point of interest. We either respect it or we sweep it ever so slightly above. If we get a candle closure above, it's no longer valid. Only if we get a sweep above the high with these wick closures, not body closures. So let me make that very clear. If we have a wick closure, as you can see over here, but not a body closure, we can still expect that this point of interest will be respected. And by respected, what does that mean? We then eventually expect for price to continue downwards. So it's as simple as that, really. We've got two main type of point of interest reactions. Now, again, like I've said, the type of reaction you do not want to see is this, a body closure up above. The reason I say that is because we are now actually changing character and we are looking to the upside now. Now, getting into the fourth part of the fifth module, we have market flow and liquidity. Now, market flow is very important. And the reason I say that is because just like how we're in a flow state when we come into our trading and practicing and everything, there also are times where the market is in a flow state. And what I mean by that is this. We've got two main types of areas. We've got one, which is a well-filled area, which is slower movement. And then we've got two, which is an area of an imbalance. Now, these main two areas are honestly, if you understand these two things, you will get very far with your trading. Type number one, well-filled orders. What do I mean by this? This is pretty much areas of consolidation. Now, why is it well-filled orders? Because we are getting both buys and sells. Buys and sells, buys and sells. And the reason that happens, or the consequence of that happening, is we stay within this range. However, if we get just buys, 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 we're obviously going to be increasing in price. However, if we get just sell, sell, sells, we're obviously just going to be decreasing in price. So it makes a lot of sense. Obviously, when you put it down into the market, not many people think about the logic of the market. You know, I think that's one of the things that really made a difference for me, especially my trading journey. When I really sat down and I understood, why does the market move? Okay, so I understand it's based on fundamentals. It's then how can we translate this into price? How does price look in certain areas? That's when I really started to develop a lot of things. So yeah, type number one, well-filled orders over here. And as you can see, slower movement will stick to order flow nicely on the lower time frame. We'll talk about that in a bit more detail. The second type is going to be this, areas of imbalances. Now, the reason we look at this is because of this. It's faster movement and it's very quick movement outside of zones. So whereas in these slower zones, we can actually get pullbacks, nice order flow, pullbacks, nice order flow. In this scenario, we can't really expect that. Hence why we need to have a different approach to the market. You know, when it comes to trading, you can put it down to a few entry models, you can put it down to a few things, but you also still need to have a general understanding of the market. Again, mechanical strategies are one of the best things that you can get into, especially as a beginner trader. And this is what I base my whole strategy off. It's mechanical, so that every trader and every student that comes into my mentorship or into my group or anything, I'm not even going to talk about it. But, you know, having that mechanical approach, it really does save you from having any sort of thoughts about psychology. Does it affect me? Any sort of discretionary approach to the market. So again, areas of imbalances is really what we're going to be looking for. How can we actually use it? Now, that's one of the main things. I don't want to sit here and teach you these concepts or this knowledge and not give you something actionable. I want you to go out and actually be able to make profits with it and really use it to your advantage. So how do we actually get into this? Number one, your entry uses order flow. Number two, have areas above or below with large imbalances for price to fly into. As an example, this sounds quite confusing, but when I show you an example, it'll be very simple. As you can see over here, we've had this range over here, so slow movement. Order flow's been nice, everything's been moving nicely. We've had a change of character, as you can see, boom. Price is now returning back to this discounted area. All we look for is our entry over here, which we'll be talking about in the next module. Then where can we actually expect for price to move towards? And it's very simple. It's going to be all the way up to fill the imbalance. These imbalances, I'm telling you, are a game changer. If you are not using imbalances in your trading, trust me, you need to, because imbalances are the reason why the markets move aggressively in a certain direction. Why? Because the market is very inefficient at that point, and then we can expect for price to continue upwards. Very, very simple. You know, there's no two ways about it. If you see a massive imbalance, you can expect that price will fly into that area. And as you can see, as an example, I'm not talking about anything in theory here. It's very applicable. Go out in the markets and try it. When we have imbalances, what do we expect? We expect for price to move very aggressively into these areas. So that is basically all we're going to be looking at in terms of liquidity. If you have not even taken anything from this module or anything from anything else, please join that Discord group. I'm going to be sending out this PDF guide completely for free and you'll be able to see it. But please understand these two things. Where is price moving slowly? We have order flow. It's quite nice. Where price is moving very aggressively, we have imbalances. That's when we can expect for price to really boost into. So pair these two things together inside the strategy that works well cohesively. Then you've got a killer A+ strategy on your hands. So I'll see you all in the next module. All right, so here we go. Chapter number 6. We are finally getting into the times where we can actually put our strategy together. Now, up until now, we've talked about market structure. We've talked about liquidity. If you haven't, look back at them chapters and we'll finally get into this. But why do we actually look at supply and demand concepts? Now, the main thing here, and for me personally, why I always say this, is we need to look for our points of interest. Where are we actually going to enter the market? Because again, we can understand market structure and liquidity all we want, but if we are not getting and executing our trades, we're not going to be making any money in the Forex market. So getting straight into it, supply and demand basics. Now, I'm quite a simple guy, so I'm not going to complicate it at all for you. I could get into all the technical definitions, but let me not even confuse you. A supply zone is simply an area we look to sell from, so usually it will be quite high. A demand zone is an area we look to buy from, and usually it will be quite low. I don't know why, but when I started out on my whole SMC journey and supply and demand zone journey, just trying to remember what supply, what's demand zone, I used to struggle with. I don't know why, but the way I remember it is a supply zone. If someone has a lot of supply, they will sell it to you because, they say, for example, a friend has 100 cars and he has so much supply, he's finally going to want to sell it off and it's going to be at that price. Then we've got a demand zone. The demand is there, so we look to buy from that demand. So yeah, I don't want to confuse you guys, but that's the way that I usually remember. I don't know why it took so long in the beginning, but I guess it's just something's wrong with me, man. I don't know. Anyways, in terms of supply zones, what do we actually look for? Now, there's two main types. The first type is going to be the range demand. Oh, so in this case, we're looking at demand zone. We're actually looking at the range demand, and then we've also got the candlestick demand. Now, what do I mean by this? The range demand is basically where we have a big amount of consolidation, as you can see over here, and we basically just put a box over all of it, and that's the area we're looking at. Now, in terms of a candlestick demand, this is where we get a lot more specific, and we're going to be talking about that in a few more examples just after this. Now, we're talking about the types of supply. Mind the title, but obviously it is meant to be that. We've got range supply and we've got candlestick supply. Same concept supply. It's all going to be about where are we going to be looking at in terms of the range. We draw that box. And then in terms of the candlestick supply, it's always going to be about being a bit more specific. And that's where we start to talk about order blocks. This is something that, a lot of SMC traders talk about. Is it an order block? Is it supply and demand zones? In my opinion, it really does not matter. As long as you're marking your zones correctly and you're trying to get into them trades, it's all well and good. Now, in terms of our three types of order blocks, so like I've just said, supply and demand zones / order blocks is all the same thing, just a different name, all rebranded stuff in my opinion. Now, in my opinion, like I've said, it's nothing more than just an innovation of supply and demand zones. And supply and demand zones is probably an innovation of something else. This stuff is all cyclical. You know, you get marketers that come again and again and again. One of the biggest phases recently has been ICT concepts, for example. You know, before ICT concepts, what did retail traders use? I don't know. You know, I've been trading since sort of 2018, around that time. And since then, it's mainly been sort of retail concepts, ICT concepts, order blocks, supply and demand, all that kind of stuff. But either way, it really doesn't matter how we are actually going to get into these order blocks. Now, in basic terms, let me explain to you what it is. An order block is as follows. The last up move before the down move. So as you can see over here, this was the last candle up before the next candle moved downwards. And again, the order block sort of down below is going to be the last down move, this one over here, before the up move. And it's very, very simple. Once you have that, you mark out the entire zone. So you could mark it out in different ways. Again, most people usually mark it out from the wick to the wick. And we'll get into a few examples of how that looks. So type number one, we have the standard order block. Now this one is possibly one of the most classic order blocks that everyone's uses. Is going to be the last up candle before the next down, before the candle afterwards. So let me start that again. Type number one is going to be the standard order block. All it is very, very simple. It's going to be the last up move before the down move. And all we look for is to mark out basically from wick to wick. We mark out that zone, and that is basically our order block that we're going to be looking at. Type number two is going to be the engulfed order block. So what this is where we simply get any type of candle. It could be an up move, could be a down move, but the next candles have to close below it, or they have to close above it. So in this example over here, as you can see, this engulfed order block was the last one over here. The next candles, that's where we really started to close below it. And as you can see, price really nicely taps back into that area. So very simple. Type number two is an engulfed order block. Type number three is going to be a breaker block. Now, a breaker block is slightly more complicated. It's pretty much an area or a previous order block that has been broken through, and now we are returning to it. So very simply, this order block used to be valid for a buy. However, what price decided to do is decided to sell. It completely broke through all the levels. As soon as it broke through, price started to reverse back to it. And then as you can see, this breaker block was very nicely respected and started to sell off. So very, very simple. This honestly reminds me so much of support and resistance. And this is why I always say, I believe supply and demand, ICTs, SMC, all of this stuff has originated from the same type of concepts. Again, when we're looking at technical analysis, we're all looking at the same chart. No one is looking at a special chart that's different. Perhaps maybe apart from order flow charts that is slightly different and more complicated, but we're all looking at the same type of things. We're all looking at the same candlesticks, and we are trading off of that. Type number four is going to be a mid-range continuation order block. So this is very simple. It's pretty much an order block that has been left within a range. Typically, it's surrounded by a massive imbalance either to the upside or to the downside as well. And usually this can get touched. In my opinion, this is possibly one of the weaker order blocks out there. Again, this is why I always recommend when you get to these areas, don't just enter straight away on just a limit, but actually enter with some sort of confirmation as well. And guys, as we are going through this, please, this is a massive webinar for all of you and completely for free. So please leave that like below. I would really appreciate that. So 2 rules that we need to know. High quality order blocks, what are they? Now, when we're looking for high quality order blocks, we must consider 2 things. The first one is the order block must have broken some sort of structure. Number 2, the order block must have created an imbalance above or below it. Now, we'll be getting into some examples over here. Now, when we're talking about high quality order blocks, the rule number 1 that we do look at is the order block must cause a break of structure. So as you can see in this little example over here, the order block down below causes break of structure to exceed this high. As soon as that happens and price returns back to it, that's when we can start to expect. So in this example, we've got the engulfed order block because the next candle obviously engulfed it afterwards. And as price pulls back to it, we can see it very, very nicely respects it. Rule number 2 for a high quality order block, an order block that generates an imbalance above or below it. Now, as an example, as you can see over here, we had the order block not only create a breaker structure up above, the next candle created a massive imbalance just afterwards. Now, this is typically what we'd refer to as the fair value gap. Eventually, this gets touched into. possibly at the fair value gap / at the order block as well. So again, it is just going to depend on what you do like to enter on. But yeah, very, very simple. These are the two high quality sort of references that we do look at when we're looking at very nice order blocks. Now, this is a topic that I wanted to get into, order blocks versus fair value gaps. Now, if you are within the ICT sort of space, you would understand that fair value gaps is a concept that's used very, very often. Again, similar types of things for order blocks, but I'd say more recently, since more of the concepts have been coming out and everything, fair value gaps are really being used sort of more and more recently. Now, simply put, these are the same things. You know, when you look at fair value gaps and imbalances, they're just rebranded from different educators online. Again, this is what happens in business. When you've got a product, most products are not innovations. They're not inventions, they're innovations. So when you look at anything, the laptop, this MacBook right here that I'm working with is an innovation of the original invention of a laptop, for example. We just constantly develop and change the names up. This is my opinion, to be honest. Now, so far, we have used imbalances mainly for take profits, but we can actually use these areas for entries as well. Now, typically, I would use fair value gaps and imbalances with confirmation entries. This is usually what I base my personal strategy off as well. Obviously, I have a few other rules that are quite strict in a way and what makes it a mechanical strategy. And that's basically what helps me to my advantage in a way. Now, which one? The question now lies, what should we actually use? Fair value gaps and imbalances, or do we use order blocks? Now, let's look at the risk of using both. If we're using fair value gaps, we are basically going to be going for a lower risk, or there is a lower risk of that trade hitting that stop loss, but there's also a lower risk to reward. And my words, it's not a lower risk of losing the trade, it's actually a lower risk of missing the trade. Because if price is going to come down to that stop loss, you would have done it either way. When it comes to order blocks, we've got a higher risk of missing the trade because usually these are in very discounted or premium areas, but the risk to reward is much higher. So again, it really is going to depend on what type of trader you are. You yourself need to discover that. I can only help you up until a certain position, right? I can help you up until this webinar. You can watch this entire webinar, take notes. I can help you up until the free Discord. I'll obviously happily participate and answer with questions and everything. And obviously you've got the community to help you. But again, the final step is finding your strategy, applying it to the backtesting it for maybe 2 to 3 years on one pair. Honestly, if you don't do that, I don't think you're even serious about this journey. Now, let's just take a look at a little example over here. Now, the chart we're looking at over here is GBP USD on the 15-minute time frame. Now, what do we have over here? If we're zooming into one of the parts, as you can see, we have a very nice change of character over here on the 15-minute time frame. Now, we have a change of character with a body closure above. Remember, that is my number one rule when we're looking at solid change of characters. Once that happens, as you can see, price starts to pull back. Now, here's what the question is. As price continue upwards, where would you actually look to enter? You've got option A, which is the order block, and we have option B, which is the imbalance / the fair value gap. So just take a second, have a little think. Are you going to enter more extremely, or are you going to enter on something that's a bit more lenient? Now, again, it really is going to depend on what type of trader you are, but let's just see how this turned out. As you can see, if you did enter on option A, which is the order block, you would have missed your entry. So again, it really depends. Are you willing to miss out on certain trades just for that extra bit of risk to reward? Or are you willing to go in with a fair value gap and with a, not so much of a premium / a discounted area and more of an extreme area? So it is all about how you weigh these kind of things. Now, as you can see, the trade ran off without even pulling back to the extreme order block. So what we basically need to do is, if you want to go for the lower risk approach, enter on these fair value gaps. And as you can see, that would have been over here, entry, your stop loss just below the lows. Now, again, some people do differ on where they actually leave their stop losses, but it really depends on what type of trader you are. Now, my advice, choosing entries. Some key takeaway points from this entire module. Don't be over specific with your entries, trying to hit the highest risk to reward. If you hit an imbalance / a fair value gap and you've not yet reached the order block, but all your other confirmations are in line, I would say enter. And the reason I say that is because it works for myself. And I don't say that just out of nowhere. I say this from experience, from all the times that I've been trading, from all the times that I've been teaching, from all the times that I've backtested my strategy. I see this happen time and time again. So either take my word for it or not. I believe this is the route that I personally take as well, and something that you could. Now, in terms of entries, it's the least important part of SMC. Remember, we always have to refer back to our main 4 things. Number 1, market structure. Number 2, liquidity. 3, we've got supply and demand zones. And number 4, we've got all our other confirmations. So again, up until now, we basically covered 3 parts. We've covered market structure, liquidity, and supply and demand zones. So that is pretty much what it's going to be about. Now, obviously, we're going to be moving into chapter number 7. But please, for everything that we've looked at in chapter number 6, have a look, really do take notes on it and, study it in detail, because all of this that we've talked about over here, remember, we need to take it in steps when we're taking our strategy. But once we get into this stage, you're now becoming more of an advanced trader. You're actually looking for entry points. We understand that, okay, if we are looking at a point of interest, how can we actually react to these? Once we get that change of character, can we enter off the fair value gap or the order block? So guys, that is a wrap for chapter number 6. And here we go, chapter number 7, the final module of this entire course. Again, guys, I really do hope you have appreciated everything. If you do really want to show that appreciation, and obviously I've taken my time to put out all this content, and I know so many traders out there, so many educators are literally selling courses of all this information, and you can just have it for free. Literally not a penny to it. So remember, please like and subscribe below, leave a comment, and also obviously join the free Discord if you do want to enter my community. It's completely for free, nothing is required. Now we're getting into chapter number 7, so advanced liquidity theorems. I think this is the part that a lot of you have waited for, and I hope if you have skipped to this area, at least you're going to take notes. At least you're taking notes, even if you've skipped past all of this. Again, like I've said, we've been here for, probably close to 2 hours, something like that. So again, a lot of detail throughout all of this, but now's the time that we actually apply all our knowledge and how we can get into actual trades. Already from all of this knowledge, I've received so many emails from you guys saying, how beneficial it's been, and you're going to see what I'm talking about. The liquidity theorem introduction. So I want to introduce this entire thing first of all. Now, before we get into what liquidity theorems is, we must firstly understand, why are we even looking into this? Why can we not just use standard SMC that everyone has learned? Does SMC not work anymore? What can we use instead now? This is probably questions that you might have. Why have I basically changed my whole mindset about SMC? SMC is great, and there's nothing wrong with it. ICT and SMC and whatever you want to call it. Personally, I feel that many traders understand the concepts and they get into the markets. They don't go in with testing. They don't go in with anything. And they just go, in a way, blind into markets thinking, okay, I'm just going to enter off this order block or this fair value gap. You need to understand one thing. There's so many order blocks and there's so many fair value gaps in the market that you can enter off. So the question is, which one do I actually enter from? And that's the problem that many people find. And that's what I want to talk about in this module. And that's why I think this is possibly going to be maybe even the best 10-15 minutes of this entire video. So yeah, let's get straight into this all. Now, essentially, what we're going to learn is how to use liquidity to gain a high level of understanding of the Forex markets. Thus, we'll be able to develop a strategy from this. Now, this has rarely been spoken about in public before, but here it is. The different levels. So we're going to be talking about 4 different levels. We've got the weekly candle liquidity, daily candle liquidity, intraday session liquidity, and then we've got the liquidity theorem entry models. So everything is going to be leading up until that entry model in a way. So part number 1 that we're going to be looking at is candlestick mastery. This is before we get into anything at all. The reason I say this is because of this. Price action is pretty much an understanding of how these candles move. So if we understand and we can master the candlesticks, we can understand it to a deeper level. Now, what do I mean by all of this? Now, going forwards and looking at liquidity theorems, you need to have an excellent understanding of candlesticks. And the reason I say excellent is because if you don't have experience with it, trust me, you're going to struggle with it. More importantly, you need to really understand how they work in trends, how they are rejecting an area or engulfing an area. So what do I mean by all of this? Let's just go back to basics. Now, in terms of a candle, what is it comprised of? We've got the open of the candle, we've got the closure of the candle, the session low and the session high. Now, throughout all of this, we are either going to be downtrending or uptrending. So say, for example, in an uptrend, Of course, we can expect the open of the candle to be down here, and then the uptrend, as we are uptrending, the closure of the candle to be up top. And from that, obviously, we can understand quite a few things. Now, in terms of a trending environment, let's just take a look at this little example over here. So I've just zoomed into this tiny frame over here. Now notice this little thing. A small move to the upside, leaving a wick at the top. Then it pushes all the way down. Then it retraces slightly up, leaving a wick at the bottom. So what do I mean by all of this? We're in a downtrend, right? So let's refer back to this point over here. In a downtrend, we have the open of the candle. We have the closure of the candle, the session low, the session high. So if we are expecting the open of the candle to open, and we are in a downtrend, typically at some point we are going to get a high. Price will then reduce all the way down and then give a little retracement to the closure of the candle. So let's just take a look at this little example over here. Let's just say this candle over here. We opened here. We moved perhaps maybe a few minutes or a few seconds, whatever time frame we're on. We've moved further up just for a little bit. And then we've expanded all the way down to this zone over here. And then we've retraced all the way down to the closure of the candle. This is as simple as it gets in terms of candlesticks. Now, candlesticks are not hard to understand, but once we do understand them, they have so much knowledge inside them that we can actually use. How they close, how they open, and how they move about as well. Now, how can this help us? Again, like I've said, we can use this and apply this to trending markets. I wouldn't say it's much of a big thing in terms of consolidations. Perhaps slightly when it comes to liquidity sweeps, but beyond that, not so much. So again, we're going to be using it in trending environments. So part number 3 of this module, we're going to be looking at highs and lows. Now, highs and lows of swings, why are we going to be looking at? Now, the reason we look at that is because we need to identify important levels of structure in our various scenarios. For example, on a high time frame trend, such as a daily chart, we can understand the highs and lows. Now let's just take a look at this little example. Highs and lows of swings are defined by 3 things. We pretty much have a move to the top. The middle candle is going to be the high, let's say in an uptrend. The next candle is going to engulf it further downwards. So in a way, you can define it in these 3 candle patterns. Now again, it's not always defined as 3 candles. It could be 4, could be 5. Anything more than 5, obviously I'd be a bit iffy about that because I would consider that as a consolidation. But anything around that kind of range would be okay. Typically, what I define it as this. The middle candle has to be the higher one. The third candle or the last candle, could be a series of 4 or 5 candles, has to be something where it actually exceeds it and engulfs it downwards. Again, the same type of concepts can be applied sort of on the downtrend and reversing. Now let's take a look at some examples of swing lows. As you can see over here, very, very simply, price actually starts to swing low over here. As soon as that happens, price moves upwards. Again, this example over here has 4 candles. This one over here has 3. This one has 3. This one has probably about 4, 5. And this one has about 4. So you're looking around that range when we're looking at swing lows / swing highs. Now let's just take a look at swing highs now. Price is exceeded to the upside, 1 candle up top, engulfing candle afterwards. Again, with this one over here, this is what we define it as. And on the higher time frame, when we zoom out, we can very, very easily see this on the higher time frame. It's very, very simple. So that's pretty much all we're going to be looking at. How can we actually use this to our advantage? Now, we use areas above or below these swing points as major areas of liquidity that we can aim for. Refer back to that liquidity chapter that we talked about, I believe in module 3 or 4. I believe it was number 4, where we talked about it, where we're looking at liquidity points. Buy side and sell side liquidity, they always happen at these primary highs and primary low swing points. This is a reference back to that primary and secondary high sort of module. So obviously look back at that. And yeah, always aim for liquidity around these areas, not at random candles in between the ranges, because they honestly mean nothing. So now we're getting into part number 4, swing point liquidity. What are we going to be talking about over here? So going back to our visuals over here, how can we actually find the liquidity here? The swing high liquidity would be resting just above the actual high of the swing. The next candle over here drops past the high. Then in terms of the next point, the swing low liquidity, we're going to be looking at the next part. The next candle will rise past the low. So always, we're going to be looking at these key levels of liquidity above and below these swings. So it's going to be as simple as that. Now, in terms of practice, what I would say is obviously hopping on the charts and, taking a look at a few of these examples, just taking a look at this trade and view example over here. How can we actually define these swing highs and lows? First example over here, a low engulfing to the next one. As you can see, a liquidity sort of resting just below over there. Then we have the high up top, as you can see. Again, like I usually say, we should mark out the liquidity from the top. So I would, in hindsight, I'd probably leave it over there. Again, it is the general area that we are looking at. Always, when we are looking for take profit zones or looking for inducements, we are going to be looking for a liquidity sweep of the high anyways. Again, you can just see this over and over and over again. Now, we're getting into the crux of this all, the weekly liquidity theory. So how are we actually going to use this to our advantage? Now, the weekly candle can be looked at on before the open of a fresh week to give an indication of where we might be moving next. Now, remember the basics of candlesticks from the previous lessons we will actually use over here. So how can we predict the market or the movements of the market? There are going to be two ways. There are going to be two ways that we can actually predict the weekly candle. The first one is going to be a continuation. The second one is going to be a range in market. Now, for the first one of the weekly prediction, we've got the continuation. Now, remember, the main point here in a trending market is that we usually have the low of the week early on. The high of the week is much later on. And then our aim is to basically get a closure above, at least above where we actually open. So in turn, that will mean, we are actually moving in a buy trend. As an example, this weekly candle is what it looks like. But in reality, when we move into the lower time frames and actually zoom in, this is what it will look like. We have consolidation, a low of the week, price expands, and then starts to retrace at the end of the week. So if you really look at everything in terms of the market, everything can be reduced down to the lower time frame and just looking at how do the candles actually look. So that's something that I'd always recommend for everyone. In terms of a range of market, something like this is hard to predict and usually something that we should avoid. Now, again, it can come in many, many forms. But just as an example over here, as you can see, price opened up over here. It moved upwards first rather than moving down. It then moved downwards, then up and back down all the way pretty much back to break even of where it was in the beginning. So that's something that we do look at the weekly candle. Now, you might be asking now, how do we actually know which condition we have? Now, we can notice this based on price action on the weekly time frame, as we'll do now as an example. Other points as well, knowing how much news is going to be coming up. So again, if you know some big hitting news is going to be coming out, whether it's NFP, whether it's FOMC or anything like that, of course we are going to be getting, massive moves in the markets. And again, we can expect price to move aggressively. So that could indicate a trend in market. The daily liquidity theory. So let's get into that one as well. Similar to the weekly liquidity theory, but here we're going to be going into it much more often than usual. So what you need to do is this. Mark out previous daily highs and lows every single day. So before you get into London session for the new day or for the new trading day, pretty much what we're going to be looking for is marking out the previous daily high and the previous daily low. Then we look at previous daily price action. Are we trending or are we consolidating? So step number one, previous daily highs and lows. In the same way that that significant highs and lows are important to the market, the previous daily highs and lows can also be very important. So all we're going to do here is mark it out and see if price decides to take it out and reverse. This is obviously not applicable to all situations, but it might be helpful at times. As an example over here, and this is where we really start to get into more detail. Previous daily high marked out over here. Previous daily low marked out also. Now we have the Asia range. With the Asia range over here, what are we expecting? So let's just say we're in a buy trend. We're expecting only buys, right? So I would expect the lows to be taken. In this exact example, and what usually is a higher confirmation is waiting for this previous daily low to get swept. As soon as that's swept, we have some sort of confirmation, and that's when we can actually enter. Where would I look for take profits? Look for the imbalance, look for the break of structure, and further on if we have other points. Now, an example of the previous daily high being taken and reversing is this one over here recently on Euro USD. As you can see over here, we had the buy trend up until here. Previous daily high was taken, but the important thing, once it was taken, we had the change of character down, closure below. As you can see this candle over here, very cleanly had a body closure below. And then price started to retrace upwards As soon as we had that retracement, back into the fair value gap and the order block, and then price started to drop off completely. So this is something that we look at over and over and over again, something that's very easily replicable. Number 2 is going to be predicting the next daily move. Now, in the same way that significant highs and lows are important in the market, the previous daily high and low can also be very important. Now, all we look for here is to mark out and see if price decides to take it out and reverse. Again, this is not applicable to all situations, but it may be helpful at some times. So number 2, when we're looking at bullish moves, continuations, if, for example, we have seen that price has had a bullish candle one day, the next day it's also had a bullish candle, what can we expect for the next day? It's closed over here. We can also expect for price to push upwards, unless we have some sort of news or fundamentals that is suggesting otherwise. This is why I keep all my students up to date with fundamentals, because this is a massive factor, where price could reverse. Or for example, on the high time frame, there might be a reason that we're going to be moving downwards. For reversals, it's the opposite way around. Let's just say, for example, we are now downtrending. Price then decides to have this indecision candle, and then price starts to exceed to the upside. This will then give us that indication. As soon as we had that closure above, we've now created the swing point, and price can basically move up and power to the upside. So very, very simple. Bearish moves as well, it's the similar type of thing, just on the opposite direction. So if you are not taking notes, honestly, take screenshots, take notes and everything. It all makes sense, obviously in theory, but you obviously have to test it. For me, it's something that I've been testing for so long. For me personally, the content and the knowledge stage is done for me. It's all about the application stage. And obviously my strategy is done and been using it for a while successfully. And obviously now just using it daily. So yeah. Now we're getting into part number 7, intraday timing. So when we're talking about the intraday timings, this is obviously another important factor. Something where, when people are trading on the high time frames, it's obviously not as important. But if you are trading on the 5 minute, on the 15 minute, even the 1 minute, this is something that's always going to apply. So the intraday model will consist of a few key timings and characteristics. Now, I recommend 2 time frames to work on at first if you are an intraday trader: the 15-minute time frame and the 5-minute time frame. Now, some traders may even decide to go down to the 1-minute time frame, but I've honestly found the most consistency on the 5-minute time frame, and it provides a 1 to 3 to a 1 to 6 average using the elite strategy. Again, like I've said, this elite strategy is something that I've been using personally, something that I built for my team and everything. But yeah, this is something that we've been using. So we execute on the 5-minute time frame. Asia range. The Asia range is defined as 12 a.m. to 5 a.m. Remember, this is all GMT time, so UK time. Obviously, refer that back to wherever you are from as well. Asia range will typically consolidate. Just remember that. London session is going to be between 7 a.m. all the way up until 10 a.m. Again, I do have my kill zone, my personal kill zone, and I will explain that in the free Discord if you join. I have a completely free PDF that I will send into the students over there, and you'll have a little look. But London session, usually from around 7 a.m. to 10 a.m. is quite a good time. Then we've got New York session. New York, by the way, usually holds some kind of reversal or a continuation trade. So that's the type of thing that we do look at. Now, in terms of this, usually for New York, I'm going to be looking around 12:30 to 2:30. Again, I do have a specific sort of kill zone around that time. I will send it into the group, but that is pretty much it in terms of timings. Anything after that, in terms of London close, past 4 o'clock, that's where we really start to see price slow down. So either take profits or start to look for reversals. But again, I always recommend keep your trading within London session kill zone and also within the New York kill zone. Now we are getting onto the final sections, the intraday liquidity theory. This is the part none of you can miss. Like, honestly, if you haven't watched the entire course in this one over here, or you've played it quickly and everything, you do not want to miss this part, the intraday liquidity theory. So step number 1, marking out liquidity from Asia session. All we do, we mark out the high and the low. Step number 2, we watch how liquidity on either side of the market has taken and reversed. So usually, because my kill zone comes in a bit later in on the London session, I'm going to be waiting for something like this, a sweep just below the lows, and then some sort of reversal to the upside. Remember, London will usually create the low of the day if the daily cycle is to be respected. Step number 3. If, for example, we haven't got into a trade in London, but we want to anticipate a trade for New York, all we're going to do is this: mark out the new highs or the new significant highs and lows from London session. Once we get that, we can also, step number 4, expect a liquidity sweep of these areas. Now, this is something that not many people talk about on YouTube or on the internet. Having this actual system in place, and trust me, it really does work. Go out and backtest it. Even if, for example, you just backtest it for a month, you're going to see it works. Especially on pairs like Euro USD. This is something that I do personally. GBP USD, GBP JPY, whatever it is. Again, you can also do this on indices, commodities, whatever pair it is. And the reason it works is because everything moves in a daily cycle. You are always going to get lows of the day. You're always going to get highs of the day. What we try to do is we look for that liquidity sweep, then we look for the entry because we are looking for a continuation in a certain direction. And that is pretty much it. So how can we actually use it? And guys, I hope this has all made sense. If you do have any questions, obviously I am accessible and you know where, in that free Discord. So how can we actually use it? Number 1, remember that liquidity sweeps and inducements of a session high or low can be used to potentially give a setup for the next session. So it's always the previous session that helps us set up the next one. Number 2, once we see an inducement / a liquidity sweep, it's all about using lower time frame confirmations and getting into the trade. Number 3, this is actually a rule that I recommend. This works best when you are following a trend. So the trend is very important. So if we are bullish, we want to see an inducement of the previous session's low. So again, let me explain that. If we are expecting a buy, we are expecting a liquidity sweep of the previous session's low. So take that as a note. Pause the video and take a note of that. And it's going to be as simple as that. Now, please note, liquidity sweeps of previous sessions don't always happen. Again, there are times where price just continues upwards and it doesn't even get you into the trade. But let me tell you this. When you do and it follows the trend, you know that you are forming an A+ setup. And up until now, throughout this entire 2-hour webinar and possibly even up to 2.5 hours by now, I believe that I've taught you a lot of what you need to know. All of my experience that I've had in the past few years of trading and then eventually teaching within Diamant's Capital, you know, up until now, for example, almost 3,000 students throughout all of the mentorship and everything. But again, the whole point of this video was not to sell you on anything, simply to give you this value and to really see that you don't have to pay for courses again. If you ever are going to pay for anything, what you pay for is a dedicated community, a dedicated mentorship, and also a strategy that actually works. Because yes, you can know all this knowledge, but it's quite likely that sometimes you might actually not even have the strategy built in place. Now, how can I have entered in this market this day? As you can see over here. Now, in this example over here, I've shown examples of what the elite strategy does look like. This is something that I do talk about in a bit more detail in other places, but for now, we're just going to be talking about this. So, guys, I believe that we are pretty much coming to the end of the tutorial. Now, let me just put a last 2 comments for all of this. Now, many of you would not have been able to enter. Some people, and this is the usual SMC sort of style, and I'll keep this as a final point because we've been here for long enough. Many of you will look for lower time frame confirmations like this. You'll look for a sweep, a movement up, down, and then up. Sometimes this does not even happen, and bear in mind what this usually looks like is a lower time frame change of character, pull back down to the order block, and then they look to continue to the upside. For me personally, I find the problem with it. And the problem is this: price just shoots up and it doesn't give that lower time frame pullback. So how do we still enter? Now, my elite strategy solves this issue, and I'm not trying to push it on anyone or anything, but it's something that I use called the golden confirmation, and it really does eliminate any idea of, first of all, being tricked into positions where you are going to get stopped out, and secondly, being tricked into not being tricked but missing out on positions. So it solves these 2 big problems, and that's essentially how I've been able to increase my win rate up until now. But guys, as you can see, I'm just going to scroll back throughout this entire tutorial. Over 200 slides in this entire tutorial given out for completely free. Now, if you want this entire tutorial and you want all the slides and everything, literally, you can see I'm scrolling back and it's still not back at the start. All I'm going to urge you to do is join the free Discord group, because as you can see, there's going to be so much value in there. And yeah, the link is going to be in the description below. Guys, I really do hope you have enjoyed this video. Honestly, I don't think I will ever produce something with this much value in one concise video. Again, it did take quite long to get through this and obviously build this entire presentation, and I hope you all appreciate it. So the least you could do is leave a like below, comment, and comment on what you want to see next time. So guys, I hope you enjoyed. This has been Diamant Capital, and yeah, the provider of some of the most trading value out there for free. Guys, take care, and I'll see you all in the next one.